I want to start off today and show you my basic strategy on covered calls and cash secured puts. I'm going to try and keep this as short as possible, but I'm going to also try and be basic enough that if you're not familiar with this strategy or with options in general, you may be able to kind of work your way through that. Uh, if you're not familiar with options at all, please take the time, go to YouTube, and just get the basics of how options work. So you have a basic understanding. I use, as you can see, this is Thinkorswim from TD Ameritrade. That's the platform I use. I don't know if it's a platform you use, but that's the platform I'm going to show you how I use this strategy. You can use Interactive Brokers or anybody else, and obviously you got to familiarize yourself with their platform. I use Thinkorswim because I think for options they're one of the better platforms out there. My commissions are reasonable. They're 65 cents a contract in and 65 cents a contract out. And I'm okay with that. And, I'm not a major trader, so, I get what I get. So familiarize yourself with your platform and be comfortable with it before you start placing trades, because it's real easy to think you're making a certain trade and find out, oops, I made a different trade than I expected, and now I got to try and get out of that trade. So just know your platform. The second thing I want to talk about is account size and diversification. I'm a big believer in not having all my eggs in one basket, and I like being diversified. And so in the two accounts that I trade this strategy on, I try to have 15 to 20 different positions between the two accounts. And sometimes I've had 25, maybe even 30 positions at a time. So I don't like to put all my eggs in one basket. That said, the size of your account will dictate that. When you're buying options contracts, each contract is representative of 100 shares of the stock that you're on. So, for example, if you only had a $5,000 account, if you wanted to have 10 positions, well, those would have to be $5 positions on average to be able to do that. Well, there's not a lot of high quality stocks at the $5 level. So that's hard to be diversified and buy quality stocks in a small account. That doesn't mean it can't be done, but you're going to be taking on more risk, because if it was me and all I had was a $5,000 account, I would probably say, well, I'm going to pick two $25 stocks, or maybe three, $15 stocks, or a couple of 15s and a 20 or something. I personally would not be comfortable with most $5 stocks. Are there some decent $5 stocks? There probably are. But if the stock is trading that low, it's either new or it's a company that's in a lot of trouble. And whether or not they survive depends on too many things. And for me, it makes it too risky. So you have to define your risk and what you're willing to do. But diversification is important, because if I'm in 20 stocks and one of them has some black swan event where the CEO absconded with all the funds to Jamaica and they can't find him, or whatever, any bad thing that happens, and that one stock all of a sudden drops 50 or 60 or 70%. Well, if that's my whole account just took a hit that I may not be able to recover from, or at least I'll take years to recover from. Where if that's just one of my positions, I can weather that storm, and I still have other positions that are keeping me afloat. The stock market is risky. Whenever you're in a stock, it can fail, and the whole market can crash. I mean, we've seen it just recently. So being diversified keeps me able to sleep at night, and so it's important for me. May not be for you. You have to design this for your own tolerance level. But this strategy is a buy and hold type strategy. In other words, we know the market's going to have its ups and downs. When the market crashed in 2008 and 2009, a lot of people at the very bottom cashed out. This is horrible. I'm done. I hate the stock market. I'm out. And they cemented those big losses in. I had a family member who did just that. Those who didn't do that, who didn't panic, who just held, and if they were diversified, if they had all their stock in Lehman Brothers, they were in trouble. Or Washington, the bank, the mortgage company that went under. But if they were diversified, they weathered that storm. And if they hung on, within a few years, they had recovered all of their losses. And within 10 years, they had doubled or tripled their money. So this is a buy and hold strategy, knowing that, yeah, right now we are going through a black swan event for the entire market. And the market has seen that, and it's rebounded some. Some people think it's rebounded and will continue to rebound. A lot of people, myself is included in this camp, think that we haven't necessarily seen the low yet and that we will retest those lows. This strategy doesn't care. We're in it for the long haul. And so if you're a day trader, this is not the strategy for you. If you're even a swing trader, it begins to be a little bit of your strategy, but it's really more for the, I'm going to buy a good stock, I'm going to hold it even through the bad times, and eventually that good stock's going to come back and I'm going to make money. And the covered calls are just a way to make additional premium while you're holding that stock. In a nutshell, that's what it is. So I like to be diversified. So let's start now and let's define a covered call. A covered call, right now I have up here MS, which is Morgan Stanley, and these are the expiration dates currently available. And today is the 7th of May, so the 8th of May is just 1 day away from expiration. 15th of May is 8 days away from expiration, so forth, so on. So let's just open an 8-day out trade, and let's kick this down to a smaller window. So Morgan Stanley currently is trading for $38.90, 91 cents. Obviously, it's going to change as we sit here and talk. So right around $39, okay? And if I already own 100 shares, let's say I own 100 shares of Morgan Stanley and I just bought it a week ago and I bought it for the $39 it's trading for right now. So a covered call means here's the 39 strike. That's where I bought 100 shares. Now, if I'm willing to just cover that, if I think the stock's going to stay, in this range, and let's say 8 days from now, I could sell this covered call right now for $103. So $3, 100 shares, $103. Okay, that's the math. As the seller of the option, you collect the premium. As the buyer of the option, you pay the premium. So in the covered call and the cash secured puts strategy, we are always the seller. And as you can see, that's been vacillating between $1.03 and $1.02, and actually the mid's at $1.04, now it's at $1.03. I always take the mid. I always put that. Sometimes I'll even put it up a little bit. But, so right now you could make $102 at that 39 strike, which is the same price you paid for the stock. Divide that by $3,900, and that's 2.6% gain. And that's actually only in 8 days. Okay. So you're going to get paid 2%, over 2%, to sell that put, or sell that call, I'm sorry. And here's what happens. If on the expiration day, 15th of May, 2020, the price for Morgan Stanley is $39 or above, so it hits your strike price, you're going to have those shares called away. In other words, somebody else is going to have bought those shares for those $39 a share. So you're going to get $3,900 back into your account, and you will have kept the $102 that you got paid. That's the strategy in a nutshell. Now, if I didn't want my shares to get called away, I could say, well, let's look further out. Let's go at least 30 days out, or 29 days in this case. We're going to go June 5th. If I get called away, I at least want to make $1 a share. So I'm going to do this one. I'm going to sell 40 strike, okay, at $1.42. So I'm going to make $142. Divide that by the $3,900 I invested. Well, I'm getting paid 3.6% in a month. So that's my monthly return, 3.6%, because this is basically at a month. I'm going to make 3.6% on that money. And if they get called away, I'll make an additional $100 on the shares. So actually, if they get called away, I'll make 242 divided by the 3,900. That's 6.2% if they get called away. Now, here's where people are funny about this strategy. People say to me all the time, well, but what if the stock goes up to $44? So you did it at 40, and so you're going to give away $400 that you could have made if you'd have just held the stock, right? Well, of course, that's true. I don't know if it's going to go to $44. I kind of highly doubt it. And in fact, if you look at the delta, they're saying it has about a 14% chance that it'll make it to $44. It's just a mathematic computation of what the odds are that it makes it to $44. And there's an 86% chance it won't. Okay. Now, this 40 has a 42% delta. So you're almost at a 50-50 chance that it's going to hit that 40 strike price and you're going to have your shares called away. So I look at it from a standpoint of I'm happy making 6%. Would I have been happier making $400 more? Of course I would have been. But I can't predict the future. If I say, well, I'm only going to be happy making the $44, well, I make $26 divided by my 3,900. I'm getting 0.6% for that month of holding it. And the chances that it hits that are pretty slim. And so I still own the shares, but I only made 0.6%. I'd rather risk the shares in this case and make my $142. I'd rather do that. If my shares get called away, I got my $3,900 cash back. I got $100 extra on the shares, and I made $140 on the covered call. I'm happy with that. I'll now take that $4,000 I just got back into my account, and I'll go do this again. I might even do it again on Morgan Stanley. I might do it on a different stock. It doesn't matter. I will analyze what's going to give me the best return on the capital I have available at that time. My goal is to make 2% a month. So in this case, I've made way more than 2% a month. And so, if I was really thinking Morgan Stanley was going to go on a tear, I might go down and say, well, can I make my 2% on that $41 call? So on that one, yeah, I'd make 2.5% on getting this $100 instead of the $140. And if the stock goes up to 41, I'd make $200 more. If it doesn't, I still own the shares and I'll do a new covered call when this one expires, or I'll roll this one forward. And that's another lesson. We'll cover that in another video. You have to decide your risk and tolerance level. And for me, I tend to be okay with having the shares called away. And if you are, then you can pick closer to the at the money strikes. Some people, let's say, you had bought the shares at $3,700 and you want to keep them, then you still do this down here, but you'd make a higher percent because you got them at $37 instead of the $39 in my example. But you could also say, well, I'd be happy. They'll pay me $315 divided by my 3,700. I can make 8.5%. And if they get called away, they get called away. You have to decide what you're comfortable with and what your goals are. And you have to decide what's going to bother you. And I've had shares called away on a stock that for whatever reason, some great thing happened for it and it jumped up higher than I expected it to. And my shares were called away at a lower price than if I'd have held them. I'm okay with that because I still made my goal of my 2% a month. And let's just look at that for a second. I have a little compound your account calculator here. And let's say your account is worth $50,000. Okay. And you can make 2% a month. I've set that at 2% a month. In 12 months, your account would be worth $61,000. You'd be making at that time $1,168 a month on that $50,000. Now this is assuming you're compounding it. You're not taking the money out. If that $50,000 account after 15 years, again, remember this is a buy and hold long-term strategy, your account is now worth $1,452,000 on a $50,000 account in 15 years. I can live with 2% growth a month. That's 24% a year. Can you make more by, possibly having a crystal ball and saying, well, I knew Morgan Stanley was going to get to 44, and I'd rather have the $428 here than the $242 here. And see, that's the difference. If I do the 40 strike, I'm going to make $142. Remember I bought these at $39. So I'm going to make $100 more per share, a dollar more per share, $100 more for those 100 shares, plus the 142 I got paid in premium. So I'm going to make $242. Okay, if it gets called away. If it makes it to $44, I'll make $529. I'll make more than double. But the chances that it's going to get that high are slimmer. So I've kept that money tied up for a smaller premium on the off chance that it'll take a big move up in 30 days. The kind of stocks I'm buying don't typically do that. They occasionally do, but they don't typically do that. So I'm more in this range. I'm gonna try and keep my happiness in this range. I'll be happy with the $142 plus the $100 more for the shares that got called away. I'm happy with that. That's $242 divided by the 3,900. That's 6.2% in 1 month. That beats the heck out of my goal here of 2%. If I change that to 6%, man, you'd see that ending account value go through the roof. Okay, so that's the covered call strategy. Now you got to have shares to cover, right? You can't do a covered call if you don't own shares. So there's basically two basic ways to buy shares. Okay, there's a market order and there's a limit order. And so let's say right now I didn't own Morgan Stanley, and as you can see, it's trading at $38.99, $38.98. You know, it's right around $39. So I could immediately buy 100 shares for roughly $3,900, and everything we just talked about would come to fruition. Okay, I'd either make the $142, and I'd still have the shares because it didn't hit my strike at the expiration, or I'd have the shares called away, and I made $242, which was 6%. And so I could right now decide I'm going to go buy these shares right now. Okay, so I can do that. I can click on here and say I'm going to buy these. I'm going to buy 100 shares. You can see down here. And right now it's showing this is a limit order. A limit order allows me to set the price. I say, well, it's been moving around $38.95 or so. I'm gonna put it at $38.95, and I can hit confirm and send. And once the price comes back down to hit that $38.95, I'm in, right? I own 100 shares. The other thing I can do is I can do what's called a market order. And a market order just means it's going to send it as soon as I hit confirm and send. It's going to go find me the best price right at that moment. And, you know, it looks like right now it'd be $38.99 or $39 if I sent those through, okay? Well, that's great. But what happens is right as I hit confirm and send, we get a spike in the market. Now, Morgan Stanley doesn't do big spikes very often, but occasionally some little piece of news comes out just as you're saying it, or some market maker comes in right at that moment and decides they're going to push the price up. And all of a sudden you get filled at a different price than you were expecting. And so I don't like market orders. I think they're a little more dangerous. So I always do a limit order, and I set my price. Now, see, right now it's at $38.97, then it went to $98. You know, I'm pretty sure if I hit it at $38.97, I would get filled, but I'd be guaranteed I'd get filled at $38.97, not at some spike price. Because market orders go out there, and market orders can sometimes get filled at a substantially higher price than what you were expecting. You know, maybe in this case, $39.20 or something. Is that a big deal? Well, yeah, it's $20. It affects our returns. So I only do limit orders. Now, there is a third way to buy those shares. Let's say I want to get into Morgan Stanley real quick. So I could go back to this little options chain of tomorrow's expiration date. And I'm going to look at the put side. And I'm going to do what's called a cash secured put. Now, cash secured put is the same thing as making a limit order. As soon as I make that limit order, those funds are immediately reserved. I can't go create another limit order that would conflict with that limit order for another stock if I don't have the money to cover it. The cash secured put is the same thing. You have to have the money in your account. And as soon as you click on, as soon as I sell this cash secured put for $31, I'm going to make $31 for selling this cash secured put at $38.50. Okay. I'm going to make, now if I'm willing to go to $39, I can make $50 for $39. And the broker is going to take that $3,900 and act like you spent it. Now you haven't yet, but it's setting the funds aside. If you get exercised on this option, if in fact when tomorrow it closes and the stock is trading at $39 or less, you're going to get exercised. And that means you're going to own 100 shares at $39. But you got paid $50 to place a limit order with a one-day expiration. Now, one day right now, because obviously tomorrow's Friday when I'm making this recording. Sometimes you'll do this on a Monday and that will be 5 days away. Or if it's a monthly option, it may be 15 days away. You have to, but the further away it is, the more money you're going to be paid. So for example, let's just go look. If I'm willing to wait to the 15th of May for that $39 price, well, now I'm going to get pay $109 for that option. If I'm willing to wait to 29 days for that 39, see, now I'm going to get paid $199. $199 divided by $3,900, that's a 5% return. And I'm only going to actually own the stock if at expiration it's at 39 or less. Well, that's a pretty good deal. I'm getting paid to tie up my money for 30 days. I'm getting paid 5%, and I'll get filled. Now I could buy the shares right now at $39 and immediately start covering them, or I can say, well, no, I'm going to do this. I'll make 5% while I wait. What's the negative of this? Well, the negative is, let's say you put this, it's 30 days out. You say at $39, I'll buy 100 shares at expiration. And realize with options, as the seller, you have the obligation. As the buyer is the one who has the option. So let's say Morgan Stanley kicked down to $36 during this 30-day period. Well, you're still obligated to buy 100 shares at $39. And anytime during that period, if somebody who bought the option, who bought the put, decides, you know what? It's gone down to $36. I'm going to exercise that option. He can now force you to buy him at $39. Well, he makes $300, right? Because it's now at $36. So that option can be exercised anytime during that expiration period. It doesn't happen very often, and usually only happens when the stock makes a major move against you. In this case, since we're selling a cash secured put, moving against us means the stock is moving down in price. The price usually needs to move against you for the option to be exercised before expiration date. But it can't happen. And that's why you have to have that money set aside. The broker saying, look, if that option gets exercised, we're taking your money. And so now you'd have 100 shares that you paid $39 for, but they're now trading at 36. You're already $300 in drawdown, right? That's what can happen. But the same thing could have happened if you'd bought the shares at $39 with a limit order or a market order, and then 2 weeks later it's down to 36. You're in the same boat. And if you now own them at 39, obviously you're going to start using a covered call, and you're probably going to be getting more like $70 at the price you want now versus the 140. So when the price moves against you, you will not make as much on your covered calls because you're going to be further out of the money. And as you can see, the further out of the money I get, the less I'm getting paid on those covered calls. So if I buy them at 39 and the price moves down to 36, well, this whole window is going to shift this way, and all of these numbers are going to shift with it. And all of a sudden, to be safe, I got to say, well, I don't want to get covered at anything worse than my $39 I paid. And so all of a sudden I'm only making $60 or $70 because the price has moved against me. Okay. That's part of the risk of this market. So, if you don't like that, well, quite frankly, you shouldn't be in the stock market, because that can happen whether you're buying or selling stock or whatever options you're doing. The price can always move against you. And when it does, you're not going to make what you thought you were going to make. So That's a cash secured put. So in this scenario, I get paid $199 for this 3,900 put, and I'm making over 5% in 30 days, and I'm just holding it. So if I've bought that for her and the stock is trading at $39 or less, I'm going to own those shares. If it's trading at $39.01 or more, I'm not going to own the shares. I'm just going to have kept the premium. I get my $3,900 released back to my account, and I go do this again. Cash secured puts are a way to make money on a limit order. And now for me, I have to decide, how bad do I want this stock? So if it was me at this time, I'd be looking closer on the expiration on the cash secured put rather than further out. And my goal is to make 2% a month. So I look at this and I go, okay, this is 8 days out, so it's about a third of a month. So I need to make, a certain amount. So I have a little calculator that I've created that tells me if I put the expiration date in, which is in this case it's 8 days out, right? So I'm 8 days out. I put my strike price in. In this case, let's say $37 is my strike price. In other words, I want to own Morgan Stanley, but I want to own it cheaper than what it's going for right now. So I put $37 in. That tells me the amount needed in my account is $3,700. And in this case, at 37, I'm going to make a $44 premium. And it has an 8 days to expiration. That's a 4.46 monthly return. Now, you say, well, no, it's not 4.46. 44 divided by 3,700 is actually only 1.18%. That's right. But see, I'm looking for a 30-day average of 2%. So I take the premium, divide it by the number of days, times it by 30, and then divide it by the amount needed. And I come up with a 30-day return of 4.46%. Meaning, if I could make $44 premium in 8 days, 8 divided by 30 is 0.26 of a month. So if I can make $44 ultimately almost 4 times, that 1% becomes over 4%. I hope that makes sense to you. That's how I figure it. I'm not trying to exaggerate this return. It's just I'm trying to figure out how much I make average on a 30-day return with the premium. So if that premium was only $20, then I'd only be making a 2% return. But I'm okay with that too, obviously. If it was $15, now I'm only making 1.5%. That doesn't fit my goal. My goal is 2%. So if you look down here, let's say we went down to the 35 strike. So let's change this to $35. And that 35 strike right now is going to give us a $19 premium, still the 8 days. So I could go all the way down to the 35 strike and make my 2% goal. Now you'd say, well, why don't you just get the higher premium and then own the stock? That's the question. That's the question you have to in your mind say, am I going to be happy owning this stock at $39? I may be, I don't know. Would I be happier if I owned it at $35? Well, yeah, obviously. If for some reason the stock falls and I own it at 35, well, that sure as heck beats me owning it at 39 and having it fall to 35. And so I got in at a better price. I have a better chance of my covered calls being profitable. So I like to go further out of the money on the cash secured put. That's a personal preference. Some people would say, well, you know what? I really want to own the stock, so I'm going to go to the nearest expiration, and I'm going to click right at the money, and I'll get paid. So in this example right now, the stock is selling for $39.06. You could get paid $47 to wait 1 day and own it at 39 even, right? So really, you ended up owning it at, if you don't count your premium, you ended up buying it at $38.54. So 1 day, that's all I had to wait. It's totally up to you. I tend to say I'd rather be about a week or two out. So let's even look at 2 weeks. And the 35, I could make $38. So let's pull up my little calculator again here. It's 35. I can make $39, but my days to expiration is now 15. Well, I can make 2.23% on that option. I'm a little further out. I've had 15 days. I make my 2%, but my goal is 2%. I'm over my goal. And I've tied up $3,500. I got this. So you have to decide what works the best for you. When I'm doing cash secured puts, I tend to stay closer to expiration. 1 week, half a week to maybe as much as 2 weeks out. I don't like to go longer than that because a lot can happen in that time frame, especially right now in these volatile times. I'm more comfortable keeping that tight. And quite honestly, right now, I am more comfortable hoping I don't own the stock because I don't know what the stock is going to do right now. So I'm more comfortable just saying, you know what? I'll make money on cash secured puts in hopes that I don't get filled. But I have to tell myself, if I do get filled at that price with that stock, I'm okay owning it. And if I pull up a Morgan Stanley chart here and I look at last few months, and I'm going to get in at $35 right here, well, it's only spent a few, maybe 2 weeks, maybe 30 days worth. I don't know what that is. This is a daily chart. Looks like about 20 days worth of time where it's been below that price. And so if the stock market retests some of these lows, I'm still in at a pretty decent price that I can call my way out of it. I don't want to buy the stock up here. I don't want to buy it at 57. I don't want to buy it at 55. I don't even necessarily want to buy it at 39 because that's kind of where it's been averaging the last month and a half. And if the market takes another turn for the worse, I'd rather have a better price on it. That's just me. If I was going to do Morgan Stanley, I'd probably look at this 8 days out. I'd look at this 35 strike, and then I'd go to my calculator. I'd say I'm 8 days out on the 35 strike, and I'm getting paid $18. That's 1.93%. That's right on my borderline. I'd probably take that trade. I may look at the 35.50, and on the 35.50 I make $23. That gets me to 2.4%. So I'd have to look at that and say, am I okay being here or here? Okay, it's a personal decision. I can't tell you what's right or wrong. It's just a decision you have to make, and that's the whole thing with investing is you have to make the decision. You have to live with the consequences, be they good, be they bad. But this strategy, if I bought Morgan Stanley at $35.50 or $35, I figure within a year or two, even if the market comes back down, within a year or two, things are going to come back up, and eventually Morgan Stanley is going to come back up and test these highs and even go higher. On a buy and hold, as long as I'm covering those calls and I'm keeping it out of the money a few slots. If I get covered and they call my shares away, then I'll go reinvest that money either back in Morgan Stanley. Half the time when something goes up, if you wait a week or two, it comes back down and retests, where it was. So you may be able to get back in. Well, I'd immediately, if I still believed in Morgan Stanley, I'd immediately go a few shots out of the money, start doing cash secured puts again, making my 2%. If Morgan Stanley never comes down to those, well, then guess what? I just keep making my 2%, and life's good, right? If Morgan Stanley, comes back down, I get back in. It's rinse and repeat. That's the way this strategy worked. Cash secured puts right now have been a major part of my income on these accounts over the last month and a half. I've done Disney, I've done Delta Airlines, I've done Roku. I've done all these stocks at where I've been able to put a lower strike. I did Disney. I started off Disney at $90 a strike because I said to myself, man, I'd be happy to own Disney at $90 with a $150 stock, a couple months ago. And then Disney came down close to that $90, not at expiration, but it was close enough that I rolled it down, made more premium, rolled it down to 85 strike. Then Disney shot back up to 105, so I rolled it back up to the 90. I did that a couple of times rolling it, and I was tying up, roughly $9,000 in capital, and I made about 5% on that over about a 5-week time period. That is not bad. That is not bad at all. I wasn't sure what was going to happen to Disney, and I didn't want to own it at 90 if it dropped to 75. So I kept an eye on it, and I was able to roll my strikes down when it got close, and then I even rolled them back up when it moved back up. My goal wasn't necessarily to own Disney. If it had happened, I'd have been okay with that, and obviously I'd have made money if it had gotten filled. But none of my strikes would have been filled at expiration at this point. But I made 5% playing with it and moving it around, and once you get a little better at this, you'll see that you can do that. And it doesn't take a ton of time, but I look at the market every day. I look at my positions every day, and if something's starting to get close to my call price and I'd like to move it up, I check. And if I can roll something for a decent credit, I never roll it for a debit unless I'm just in trouble and I'm trying to minimize a loss. And that's happened. And I'm going to do a video later that shows some of those examples. But 90% of the time, the only time I'll roll is if I'm getting paid a credit. And the credit needs to be that 2% per month average, or I'm rolling up, and the fact that I've rolled it up, the additional funds I would get if it's called away with the premium is 2% or better. And that's kind of how I work things. I hope that's been helpful. You'll probably have a lot of questions. I'm not necessarily a teacher. I'm just trying to show you what I do, and I hope that works for you. And I wish you luck. If you have questions, post them on the Facebook page, and I'll try to help you out.